Today, my guest is Todd Dexheimer. He was a school teacher. He's flipped single-family houses. He's invested in single-family rentals. And now he's syndicating multifamily properties in multiple states. And also, I should mention, he's a podcaster. Todd, welcome to CREPN Radio.
Thanks for having me on, Darren. Appreciate it.
Well, I'm excited to talk with you. We were talking a little bit before. I heard a little bit about your story on Bigger Pockets, and listened to, I think it was your first episode of Pillars of Wealth Creation, your podcast. I want to encourage all of our listeners to check that out. Lots of great stuff. But before we get into today's topic, what we're going to talk about, if you could take a minute and tell myself and the listeners a little bit more about your background and how you got into real estate.
Yeah, sure. So like you said, I started out as an industrial tech teacher, shop teacher in high school, teaching wood shop and all that kind of fun stuff. And eventually I just knew that wasn't quite for me. So as I read books and studied, I really got into real estate and liked that a lot. And it worked out perfect timing because it was in 2008 when I really felt like I learned enough to get started. It was mid-2008. So I bought my first, actually 3 properties all at once. I bought a single-family house for my wife and I to live in and kind of fix up and flip, a house hack, I think now they call it. And then I bought a rental, my first rental. That was, again, a rehab. And then I also bought a flip with a partner. So I bought those all, kind of jumped in both feet and bought those. And then from there, just continued buying. I loved what it brought me. I loved the rental, the income that I was bringing in. That very first rental just made way too much sense. And people were running the other way at that time because it was, again, it was 2008. So everybody was running the wrong way. And I was running right into it. And even though my values were decreasing, the numbers just made so much sense. I mean, I was making my net on after my mortgage, after everything, and being really conservative on this single family house, I was making $500 a month. So it just made it made so much sense. And so what I was able to do then, I was able to actually refinance that property, pull money out, and buy another rental. And I did that a couple times. They changed the rules, so I had to get a little more creative, but I kept on buying single family rentals. And the first flip actually turned out to be a flop. It didn't go very well, so I didn't do another flip until I ran out of money. And then I thought, well, geez, now I got to figure out how to make money to buy more rentals. So then I started, and teaching doesn't give you that much income. I know that shocks a lot of people, but most teachers don't make very much. I could make the same amount on one flip as I did the whole entire year teaching. So I started flipping and really took off flipping. I ended up from 2009 when I did my second flip, middle of 2009 until probably about a year and a half ago now. I did over 150 flips. And with that, I was able to then buy a decent amount of rentals as well. So I'd say I flipped 3 properties and would keep one as a rental and just kind of continue to roll that 2 or 3 properties, keep one as a rental and continue to flow like that. So that's where I was, and where I am now then is multifamily syndication. So I own properties in Cincinnati, I own properties in Milwaukee, and I'll be actually closing likely by the time this airs on a property in Lexington, Kentucky as well. So multifamily stuff, all out of state in what I've identified as emerging markets. That's kind of where I'm at today.
Got it. Well, that's a lot. I was starting to take some notes here in the very beginning. Did I hear you right? You bought 3 properties, a rental, a flip, and a house to live in almost simultaneously? Was that?
Yeah, pretty much like simultaneously. I mean, within I don't have the closings documents out, but I'd say within like a couple weeks time frame.
Wow, that is. And did you own a home before, or were you renting before?
So my wife and I bought our first house in 2005, and we got so flipping lucky because we sold in 2007. My wife, we were in a town about just an hour away from the Twin Cities where I live now. And we bought there. My wife took a job in the Twin Cities, so we knew we had to sell. So we ended up selling, and we got so lucky. It was just, the timing was unreal. We ended up breaking even on that house. And we were kind of upset at that time, like, oh man, we break even, but in hindsight now it's like, geez, if we would have kept that thing for another, just another couple months, we probably would have lost our shorts on it. So
I would say that's right around when I bought my house.
Timing was just so perfect. It was just, and the great thing is we weren't in a position to buy until mid 2008 because I was still teaching in the school up. It was near St. Cloud. And my wife she took a job in the Twin Cities. So she was actually living in the Twin Cities and I'm living up in St. Cloud. And so we weren't in a position to buy. So it worked out perfect. I mean, we definitely were blessed with how it worked out for sure.
All right. So let's talk a little bit about that. So it sounds like at the beginning, was it almost chaos? I mean, from the standpoint of, it doesn't sound like there was a defined direction as far as where you were going. It was like you needed a place to live. Sounds like you wanted to get a rental. It sounds like you'd done your reading. And then was the flip kind of a second strategy for investment, or was it just kind of like, I'll take one of those, or did you have kind of a mindset of like to build a portfolio, or what was your thought?
So, yeah, good questions. So my mindset at the beginning was I want to buy as much real estate as I can get to become a real estate investor full time. So what does that look like? What do I have to do? And so that was my mindset. And so I knew my wife and I needed a place to live. And I knew the best way to go about that was to buy something that we could build equity in. And I'm pretty skilled in construction and I don't mind getting my hands dirty. So by doing a renovation, that was a way for us to build instant equity right there. So I knew that was going to work well for us. I actually wanted a duplex, but my wife didn't want to have roommates, basically. She didn't want to have somebody next to her. So we ended up buying a single family house. But you got to make mama happy too. So
smart man.
So yeah. Sometimes. So that was for sure a strategy that I knew I had to do. And then I wanted the rental property and I didn't really want to flip, quite honestly. But so I came into it just looking just for a rental property. And then the realtor that I was working with kept on pushing me to do some flips, do flips. And the person I ended up partnering with also really wanted to do flips. So he was influential in pushing me towards the flips. So the flips just kind of came because I was almost pushed into it, saying, this is a good business to do. You get into it now. And so that's kind of how it happened. I mean, the goal from the beginning, to answer your question, was to buy rental properties. And I saw that as the way for me to replace my income, and the way for me to truly grow true wealth was to be able to buy rental properties.
Got it. And it sounded like your ideal was in duplex. But did you kind of say, okay, well, let's go the single family route, and did you have like a goal of how many to accumulate, or?
Yeah, when I first started, I wanted to accumulate 1,000 units. Yeah, so I started out with an eager goal right from the start. But really, what made it powerful for me is it took me less than a year to replace my income with my rental properties. And that's when it was like, wow, this is like, this works, and it didn't matter whether it was duplex or single family. There's just so much opportunity in the Twin Cities, Minneapolis area. We got hit really hard. We definitely were part of the party. And so and even again, in hindsight, you go, boy, man, I should have been buying way more than what I bought. But, unfortunately,
Yeah.
you don't have a crystal ball. But yeah, so it was duplexes, single families, whatever I could really get my hands on that made the numbers work is what I liked.
Gotcha. So the goal, I mean, it sounds like a very aggressive goal, 1,000 units. That's not just dipping your toe in the pond there. You said within a year you were able to replace your income. How many units did you have in a year's time?
6 units. Okay. So I had 4 single family homes and a duplex. Yeah. Okay. And I still own all those today. Actually, no, I sold one of them, but they make great income, and granted, my income as a teacher was $30,000, so it didn't take much.
No, but still, I think that the point is that recognizing that you can replace it. I know my progression was a little more chaotic than that, but the fact that you were able to have positive income, it sounds like you're very conservative. You were covering all of your expenses, not just your mortgage and insurance and taxes, which I think is a trap a lot of people fall into. But all of your repairs, vacancies, turns, all that fun stuff. So let me ask you, so from 0 to 6 with a plan to go to 1,000, did you have any systems that you developed along the way?
Yeah, developed is the key to what you just said, because I didn't come into the business knowing anything about business. I had a teaching degree and, never was taught about business. My dad, my mom, they weren't business people. So developing it is exactly what it was. It wasn't just starting with it. And so as I went, I figured out how to put systems in place so we could get the renovations done more efficiently, so we could communicate with our contractors more efficiently. We had, better spreadsheets. So, it was easier to set up the budget and all that kind of stuff. And then how do we get tenants in place and all that. So it definitely set systems up as I went. It was a trial by error, to be honest with you. I didn't have that background, and I didn't network with a ton of people that were, really being successful in it. So it was trial by error. It was, in hindsight, it was not the best way to go, but I definitely learned a lot. I mean, you learn by error.
Yeah, no, I think that's, my parents were always fond of telling me that, well, if I could have told you, but you wouldn't have learned, and let you learn by making your own mistakes. But let me ask you, so in the first year, going from 0 to 6, you mentioned at one point in the progression, I think it was more in your introduction there, a little bit about eventually you ran out of money. Yeah. How are you financing or funding these initial purchases?
Yeah, so the first 3 properties were in our personal through a mortgage, through just our Fannie Mae, Freddie Mac type mortgage. The very first one was just a mortgage. We used all the money that we had. My wife and I had whatever 25, 30 grand saved up. We used, let's say, 25 of that, and we bought that property. We fixed it up, and then there we were out of money. I didn't know what to do. I was just trying to figure out what to do. I actually went to a real estate kind of seminar, I guess. And it was a banker that said, hey, let's refinance this property. You've got a ton of equity in it, sounds like, and we can refinance it. And then I got a cool system where we can get you into another one. So that's what we did. And so we refied, and I bought another one, and refied that, bought another one, and kept on going like that. So I really had almost no money out of pocket in the end, anywhere from 0 to 10 grand. But again, mind you, I only started with like 25 grand, so I didn't have much. So I bought those in my personal name, and then I actually formed a partnership with just a friend from college, and he bought 2 in his personal name, and we just were splitting the profits on those. So out of those 6 units. 2 of those were actually owned in a partnership. But even with that, it was enough to be able to get 30 grand a year. So yeah, I ran out of money before I even got to my 6. I had to partner to get to those 6.
Right. Well, but I love just kind of hearing about that, because I think when you're standing on the sidelines trying to figure it out, maybe you've got that little pot of money that you can invest, that you can dedicate, but pretty quickly you got to figure out some additional strategies from additional cash or for some additional cash, and just to talk through it a little bit, because I think that until you get there, a lot of times you're like, oh, now what do we do, kind of thing, and to realize that you've built the equity there, and there's lenders that are willing to lend against a cash producing property there, or that there's a lot of equity, and there's an opportunity there.
And this was a bad time, right? I mean, this was 2008 and 2009. So lenders were everybody was running the other way. And most people just didn't think you could actually get financing. I think that was a big mistake a lot of people made. Is I would hear it over and over, oh, you can't get financing. You got to use hard money. You got to use whatever. And it's like, no, you don't. You can go get bank money.
Right.
And now that, again, if your credit was shot, if you had a foreclosure, you're probably right. But if you didn't, there was still money out there. It was a lot harder. You had to work a lot harder. I mean, I ended up calling, several, I don't know how many banks it was. I think it was several hundred banks throughout the years to get the right financing in place. But you just had to work hard at it. And that's what people, I think, mistook, is they thought they can't do it. They're not rich. They don't have cash. Well, you're just not trying hard enough. And that's what a lot of people miss out on.
Right. No, and even just as a kind of a commentary on that, the lending thing, I mean, my experience has been, just like what you're saying, is I think there's the traditional path where you use like a mortgage broker or something like that has, access to the traditional products and stuff. But there are relationships, commercial banks or whatever, that if you go in and talk with them and lay out what you've got, they're usually pretty willing partners if you've got, something that makes sense.
Yeah, exactly.
Yeah.
And that's what it took, eventually. So at the time, you could only get 4 mortgages in your personal name. For a short period of time there, they only allowed that. And then I think they opened it up a little bit to where you could get 10, but that was really difficult. Now it's a lot easier. It's still difficult, but so yeah, after I got 4, it was like, okay, now how do I get a rental property? And everybody's telling you can't get a loan. You can't get a loan. And finally I just said, you know what, I want to get a loan, and I want to figure out how to do this. So I started just calling banks, and I found banks that were willing to lend.
Got it. So you got in the first year, you've got your 6. Have you quit your job now? Or you said you've got the replacement income. Are you full-time real estate now? Or to the year? Or?
No. So I got my 6. That was 2009. So it was a 2009, 2010 school year. I still taught. I taught 0.6 then. It was a perfect opportunity where I could either I could stay full-time, or I could teach 0.6, and I said I'll do the 0.6 because I kind of saw what was going on. But my wife didn't want me to quit, and I did want to quit, but at the same time, I mean, she was right. This was just too new. I didn't really have even a full year of income. So income on paper was better. Income per month was as good or better. But it hadn't been a full year of coming in. So I did teach another whole school year, 0.6. And then after that is when I quit. And that's when I was doing more flips, and I had accumulated several more rentals as well. Got
it. So we're through 2010 when you...
Yes. Right. So it was 2009-10 school year. So it was, June of 2010 was my last paycheck.
Gotcha. All right. So at 2010, you are a full-time real estate investor, right?
Yep. 2010. Right.
All right. At that point, how many rentals do you have?
I think it was only a few more, because by, in 2009, like I said, I ran out of the money and I had to start flipping. So then I started flipping. I think it was only maybe 2 or 3 more rental properties by that time. So I, let's say, had 8 or 9 units. But then what I also saw is, okay, so those 8 or 9 units are making me, let's say, 35 to 40 grand a year. But then I was also doing the flips. And in the meantime, I also went and got my real estate license. And I wasn't doing a lot of real estate for other people, but what it was allowing me to do is every time I bought a flip, I got income from that transaction. And every time I sold that flip, I got to keep some of the income. So I was making that, 35, 40 grand of rental income. Plus it was easy for me to show my wife, look, I mean, just with a couple flips and a little bit of realtor income, here's another, 40, 50 grand. So it was easy. The numbers were fairly easy to show her. She still didn't want me to quit. She still told me, no, you're not going to quit. You're not going to quit. You're not going to quit. And the funny thing is, we're churchgoers, and we were at church, and the pastor said something at church that resonated with both of us. And I can't remember the exact sermon, but I should, because it allowed me to quit my job. But so we're in the car, and we're both in complete silence, and we're driving down the road and going home, and we get several blocks away from church, and neither of us had talked to each other, but we both got the same thing going in our head. And she finally says, "You can quit. Just show me the numbers and you can quit."
Oh, that's funny.
I'm like, okay, sounds good. I'll show you the numbers. So that's exactly what happened. I showed her the numbers, and she goes, "Wow, okay, yeah, you can quit." So that's awesome from the pulpit. Yeah, exactly.
So anyway, so you're progressing along, and you've gone from buying some single family or a handful of rentals. You're now into the flips, and I'm assuming that the flip income is pretty significant as well, based on how many are you doing on an annualized basis?
Yeah, so it was, flip income was decent. For as far as annual basis, it varied depending on the year, anywhere from 10 to, I don't know, into the 30s. But
wow, wait a minute, 10 to 30 flips. Are you running crews, or how?
Yep.
Okay.
Yeah. So I ended up getting my contractor's license at the same time as well, in order to efficiently run the flips. So yeah, I was had several crews going that were doing those flips. I had some job leads that were really good at running them, and so.
Are these pretty much cosmetic flips, paint, carpet, kind of thing? Or are these the full?
These are the full.
Okay.
Yeah. These are like rip out walls, change load bearing, take out load bearing walls to open up so the kitchen's open to the dining room, and all kinds of stuff. Yeah, it was not just a lipstick on a pig. It was real full flip, by mold houses, by lead abatement houses, by firehouses, stuff like that. Just everything.
Okay, so you really are going from the guy that's going to get a couple rentals on the part-time to roll up my sleeves, jump all the way in, do all the construction. Well, that's wow, I didn't realize that was the extent of your flipping. That is aggressive.
Yeah, what? I mean, it worked. But one of the problems with that whole time is that I got distracted. It allowed me to get distracted, and because I had to focus so much on flipping, right? And I still bought rental properties. I mean, I bought my fair share of rental properties, and I never took. Some of the good things, I guess, is I never really took any income. I did have a business partner that was doing the flips with me. And he would take some of the income as he needed, but we didn't really take much income. We used it to buy rentals. But like I was saying, it was so distracting. That's all I got to focus on was these flips. And I actually didn't focus that much on my rentals, which showed in the rental income. Even though I was accumulating more and more rentals, and I got up to, I think, 50 single family houses. or 50 1 to 4 unit buildings, and I had a couple apartment buildings too. I wasn't making that much income on the rentals because I wasn't focused on them. So if I had a vacancy, it might sit vacant for a month, a full month, or maybe even 2 months. And if I had a tenant that wasn't paying, I kind of left them alone because I didn't have time to deal with them. And so they might get a month or two behind. So it was a distraction. And it also, I think what it did too is there was a lot of opportunity in true multifamily acquisition. And I didn't see it because I wasn't focusing on it because I was so focused on the single family flips. And so that's something for your listeners that are thinking about doing this or are doing it, is truly think about what your goal is and what is going to make you happy and what is going to make you get to where you want to be. And make sure you're focusing on that and don't let everything else be a distraction to you. I mean, the flipping would have been fine, but it probably would have been better if I would have done either the light flips like you kind of mentioned, or if I would have only been doing, 5, 6, 8 of them a year versus trying to do 20 to 30 a year. That's all I could focus on.
Right. No, and I think that's, I'm glad you were able to share a little more about that, because I think that, through TV and just the popularity of going to auctions, and you hear about, people buying and flipping and able to quit their job and make money flipping. What they don't realize until they get to a certain point is that flipping is essentially a job. I mean, you've got to do the work to get the paycheck, and you've got to get the next one so you can continue to get paid. And so, like you just said, you're almost like on a treadmill, because. Yep. And it's even like home building or whatever. The only time you get paid is when there's a sale, and so you've got to create that next sale, create that next sale kind of thing. And I'm glad you brought that up about just the focus, because when you and especially with the degree of flips you're doing, where you're getting in the systems and you're buying some projects. And just for clarity, what was an average time frame you'd be on a flip?
Probably about, from start to finish, not including the sale, about 3 to 6 months, depending on the project.
So that's a big chunk of time.
Right.
Right. I think and that's a guy that's got his license, he's got crews, he's going, you're focused on it. Mm-hmm. I mentioned I'm an insurance broker. I've got plenty of clients that think they're going to, make their wealth in flipping, and some do fairly well at it. But I think that the sad story is how many people get into it thinking that they're going to have a sale in 90 to 120 days, and a year later they've still got a project on their hands, and they've got an insurance company going, "Do you know what you're doing?" Kind of thing, and they're not making any money. And it's just there's a lesson in there. And I think what I've tried to share with people is, if you on the first one at least, take notes, make sure you're talking to everybody you can, get through it as fast as you can, and get the sale. And, but that's kind of another topic.
But understand that you're probably just going to break even on that first one as well.
Yeah. And all that time and that effort. And I think that the key thing that I keep seeing with people is they just don't understand the time. I agree. Well, it's so beautified on all these whatever 30 minutes. Yeah, you can go from a turd to a really high polished wow. Everybody can see it on. I don't even know any of those shows. Quite frankly, I've never even watched them. But they're so beautified, and it's so fake. But people get sucked into it and think, somebody was just over at our house the other day, and they found out what I did. And, I love watching flip that thing or whatever. And I'm going, that's not quite how it is, but right. Well, and I think too that it's easy to show the price. Because you can go to the public records and you can see the sale price when you bought it, the sale price when you sold it, and go, wow, look at all that money they made. And not calculate the time, the cost of the money, the cost of all the materials, the labor, So
I've had people say stuff like that to me on a house that maybe I even broke even on, or, just didn't make that much. And they go, "Oh, wow, you bought that thing for 30 grand. You sold it for 140.
You're killing it." Yeah.
Yeah. Oh my gosh. You must be filthy rich. It's like, yeah, you didn't see that it took me, 70 grand to fix this thing.
Right. And all the time and all that stuff.
And the time.
Yeah.
So.
Well, I appreciate you sharing that, because, like I said, it is a topic that I think a lot of people will. I think there are people that are in it and understand that you have to have a system, you got to run fast, and you got to get out. And then there are people that are romanticized by and try and get in and get stuck and can't figure out how to get out. But I'd like to talk a little bit about just kind of the, your strategy. It sounds like to me it's progressing. And I like to talk a lot about strategy, because I think that that's really one of the keys. And it kind of goes with focus and strategy to actually creating wealth. Because I know in my own way, it's been kind of a random, chaotic thing. I was an accidental flipper, then became a landlord, and now I'm like focused and trying to really grow it. But I'm kind of curious. So, how would you describe how your strategy has evolved from, in the beginning? It sounds like you were focused on being a landlord. You got into the flipping. Can you take us through that a little bit? How you got into where you ended up with multifamily as being the direction?
Yeah, absolutely. So when I first started, like I said earlier, my goal was 1,000 units, and I wasn't even close, right? And it was, whatever. By the time I kind of had this like thought, like I'm going, geez, I've got 50, maybe 60 units at the time. And I'm going, I'm nowhere close, and I'm never going to get there if I keep on doing what I'm doing. And that's what I want. That's where I want to be. And I can see the power in it, and I can see the profit in it. And I'll back up, because it happened like I said, I had a business partner in the flipping, and we just needed to go in different directions. I'll just leave it at that. We needed to go in different directions. And so we ended up splitting up. And at that time I went, okay, do I really want to keep on flipping, or what do I want to do? And so I took our portfolio and said, here's all the rentals, and here's what they're making, and here's what they're worth today. If I sold all those today, here's my return on investment. Here's my profit. Let's take all these flips and figure out how much I'm making on these flips and what my return on investment is on here. And my rentals destroyed the flips. I mean, just destroyed them. And I'm going, why am I spending all this time banging my head on the ground doing these flips when I've got all these rentals that are providing me really good income day to day, and in the end of it are absolutely far better investments than any flip I've ever done. So I'm going, okay, I know a single family and where that can get me. And I understand multifamily and where that can get me. So that's what I wanted to focus on. Start going, all right, now I need to go bigger. I need to figure out, how can I go from 1 to 2 to 3 maybe unit, all the way up to a 20 unit, a 50 unit, 100 unit. So that's what I started doing. And I knew that my home state market just wasn't a market that I thought I could really make a lot of money in, because our cap rates were so compressed. I just didn't think there was a lot of opportunity, and there's not a lot of distressed multifamily. It's just how our government set up, how they're really in your business. I don't think things can get distressed as much as they can in other cities. So that was the other thing, is there's just not that much opportunity. So I started researching markets, and I started looking all over the country and deciding, where do I want to actually spend money and invest? What's got the best opportunity? And so that's what I did. I studied emerging markets. I learned a lot about how to look for that kind of stuff. And I did that for probably about a year and a half before I decided to finally pull the trigger. And I kicked myself again, because I identified markets, way quicker than a year and a half. I identified them in probably, 3 to 6 months. But you also have to get that fear factor. I'm going from Minnesota all the way out to whatever, Ohio or Oklahoma or, wherever I decided to invest. So finally I got onto a plane and I flew out to several different markets, and I picked one of them that I really liked. I liked the market. I liked the opportunity. I thought I could, see myself investing there. So that's what I did, and started buying multifamily properties.
I want to back up here a second. The market, it's funny because I think that so many people I talk with get all wound up in the property. But what I'm hearing you say is the market.
Yeah.
And the more I recognize successful investors, I think that's really kind of that's the starting point, is start with the market and understand the fundamentals of the market. Can you describe some of the fundamentals you were looking for in the markets?
Yeah. So first, let's think about it. If you bought in 2009, today you're doing pretty good, right?
Mm-hmm.
Okay. So if you go into the right market, that is, let's say you bought in Austin, Texas in 1998. You look like a genius today, right?
Right.
So if you can get it into that right market, and not saying that's the only thing that matters, but if you can get in the right market, it really helps. So what do we look for? You've got to look for good population growth, and population, not only like past population growth, but where are we projected to go? So the Census Bureau has a lot of good information on their web pages. A lot of the brokerage houses like Marcus and Millichap and ARA, Colliers, all those, they have studies that'll show you where we're at today and where we're heading. Okay, so that's a really a big thing. So what's the population growth look like? Where's the unemployment? What jobs are coming into the market? So we want to see who's announcing jobs, who's announcing that they're expanding, and what's that going to do? What areas are those in specific? You get a company that brings in, let's say, 2,000 white collar jobs, and that's going to add more than just 2,000 jobs. You have to understand that, because if you've got 2,000 white collar jobs, you've also got blue collar jobs that need to service the white collar. You've got tons of jobs that are coming in. Then if you got 2,000 jobs, you probably have closer to 7,000-8,000 jobs. So you have to look at that. What I really like to look at also is what's the opportunity in that market. Okay, so we got markets like Austin, Texas, for instance. That's got some good fundamentals, but how long has it been good fundamentals? And what's the compression of the cap rates? Where's the opportunity? Is there any opportunity? I would probably say not a ton of opportunity in Austin to get a phenomenal deal right now. You're probably going to pay a pretty penny for any deal. So is that market on the top of that cycle, or is it closer to the bottom? And I'm trying to look at markets that are a little closer to the bottom, where we had higher unemployment rate, where we're now seeing new companies come in that weren't coming in before. Government's offering incentives. What's the comprehensive plan of the city? You can just Google whatever city you want. Let's say you identified Oklahoma City as a good city, okay, which it is. You can go on to Oklahoma City. You can just Google Oklahoma City comprehensive plan, and it'll pop up, and you can read, what is the city trying to do? What neighborhoods are they trying to affect? What's happening? You can also look at, is there nonprofits that are in that market that are trying to increase, opportunities for people, for opportunities for businesses. Cincinnati is one of the markets that I invest in, and they've got a nonprofit called Ready Cincinnati, and they're trying to get small businesses in, and they're trying to incentivize them to stay. Okay, so I'll go back to opportunity. Sorry, I'm a little.
No, this is all good. It's all good.
I get a little excited when I talk about this stuff. So we've got this. Where's the opportunity? Okay, so can we see in this city, and everybody's strategy is different. This is my strategy, right? Mm-hmm. I need to find a value add property, something I can add value to, and something I can increase it's worth in a fairly short amount of time. And that's just how my brain is wired. And it's not necessarily everybody's brain. So you might be able to find a great deal in Minneapolis, where I'm from, because your brain's not wired the same as me. Okay. It's a good market, other than there's just not an opportunity for high growth. Okay. So can we find properties that are distressed is what I'm looking for. Can I find properties that people aren't taking care of that can be essentially flipped into something nice? And I'm not saying flipping as far as just flipping it quickly, but and then also what I really like to see is, does that market have good affordability for renters? And I want to see where the income to the rent is at that 30%, that range. Otherwise, we get markets where you've got like a San Francisco that the tenants are paying 60% of their income towards rents. I think that's unsustainable. And I'm not just bullying San Francisco. There's a lot of markets right now that are like that, where can they sustain what they have? I would say the Twin Cities is getting very close to that, where tenants are paying 40+% of their income. Can they continue to do that? And then the last thing that I like to see, and it's not a deal breaker, but I like to see that it's more expensive for a tenant to buy a house than it is for them to rent.
Right.
Especially in that B and C class. A class is typically, it's more expensive to rent just because it's A class. So that's kind of what I'm looking at, I guess, the most. There's several other things that you want to be kind of cognizant of, but those are the biggest things for sure.
Well, and let me just ask you one other thing on the markets. We didn't talk about the size of the market. Is there a minimum size that you look for?
Yeah, I do. I want to see the MSA at least 500,000 people. I like 1 million plus, but if the city has really good fundamentals and good growth, I'll go 500 with the MSA. So the MSA is the actual city plus any of the suburbs, for those of you who don't know. I think it's really tough when you get into smaller cities. Somebody on Bigger Pockets was asking the other day, they see a lot of opportunity in the city, and the cash flow is really, really good, but it's only got a population of 10,000 people. What do you think? And I'm like, I think you should run. I don't think you should even think about it. But some people do, but I just don't think there's that great opportunity, because what happens when one tenant moves out? Can you find a new tenant? What happens when, any little thing that happens in that city, you can't do anything about it.
I think to your point, I think that a lot of people think about the get in, but they don't think about the get out. And I think, just like you said, if you've got a vacancy, how can you fill it? Well, what about when you want to sell the property?
When you want to sell it.
Yeah.
Right?
If there's nobody wants to buy it, or there's no demand for property.
Yep. Now, and with even the 500 being said, I would say is if you can get into a city that's smaller than that, but it's closer to your hometown, like if you live in that city that has, let's say, 60,000 people, should you invest there? Sure. If you live in the city with 10,000 people, should you invest there? I would say maybe not. But if it's like 60,000, 70,000 and it's got some good growth, I think there's still opportunity there. As long as you're living there, I think that's good. But if you're traveling, if you're flying out, I just think that you've got, you got to have third-party management. Well, how do you find contractors? How do you find third-party management? If the person that you hire you don't like and they don't do a good job, can you really fire them and find somebody else? They're probably the only person in town.
Yep.
So you got to think about all that stuff. But if you're in town, you can fire somebody. You can probably do the work yourself for a while until you find 6 months later somebody to take their job.
No, all of that I concur with. There is something to the size of the town and just the competition in the marketplace of service providers, like you're saying. So I think there's good reason to have that kind of a minimum size MSA, like you mentioned. I wanted to talk quick about, and I don't mean quick, but I just wanted to kind of touch on. So you've gone from investing in your own, you've gone into flipping with a partner, then you decided to get into multifamily. And I know that when we first talk, and I've heard you talk about, now you're syndicating.
Yep.
Can you talk a little bit about the mindset shift from doing your own to now you're you're syndicating, and syndicating, you've got to appeal to investors.
Yep.
Can you talk a little bit about that?
Yeah. So I'll preface this by saying I've always had partners in a lot of my deals. And in flipping, I brought on private money people to help me, continue with flipping. In some of my rentals, like I said, that after buying 3 rentals, my 4th and 5th rental were with a buddy from college who wasn't my flipping partner. And so I've always kind of liked private money partners, basically. I think that's a good opportunity to grow your portfolio. If that's what you're looking to do, is grow your portfolio, that's the best opportunity because you only have so much money. So it was more of the strategy came more out of necessity, understanding if I want to get to where I want to be, I have to include other people. So going from just a single partner to a syndication did take a while, and it took the mindset definitely had to shift of, look, let's go bigger and let's provide, because you've got to think as a syndicator, and if you can't shift your mind into thinking this way, is you're providing other people opportunity to invest in your business. And if you can't think of it like that versus I need to find people to get me wealthy, well, if you think that way, you're going to have a tough time, I think, attracting money. If you've got money and you don't want to invest traditionally in the stock market and all that kind of stuff, and even if you do, here's another opportunity. Let's diversify and bring it into real estate. And you've got to be able to think of it that way. To me, anybody who invests in one of my deals, they've got a phenomenal opportunity, right? They can take their whatever, 30 grand or 100 grand or whatever they have to invest that works for the deal, and they can turn that into a really good profit, potentially. Of course, everything's, it's a business still, but I can provide them with good returns. I can provide them, I think, with better returns than the stock market, and I think safer returns than the stock market. Now, that's all my opinion. I'm not an attorney. I'll preface, right. But that's my opinion. I think I can provide them with better returns. So, I think I'm providing a good service, and I think that's the mindset shift that you have to have when you go into syndication versus just trying to do it on your own. And even with partnership, you should have that mindset. Is that I'm providing other people with an opportunity to make more money than they can really on their own.
Right. Does this change your strategy from creating a portfolio of properties to now as a syndicator? My understanding is typically that the investment is you get in and you have an exit strategy of sunset of whether it be 5 to 10 years kind of thing. Do you have any kind of a plan to stay in those, or will you just continue to roll in and try and find the next long-term kind of a
yeah. So good question. Yeah, you definitely have to make sure you're thinking of the investors more than just yourself. It's not yourself anymore. So you have to understand the investors want to see profit, and if they're not going to see their profit, they're not going to invest. And so, yeah, it definitely is a shift from I can do whatever I want, whenever I want. I can refinance when I want. I can sell when I want. I can keep it. I can do whatever. To I've got 10, 15, 20 other people I got to really think about what's in their best interest. And so, yeah, my typical deal now is I'm going to buy it and we're going to hold it for 5 to 7 years before we sell it. We're likely not going to keep it for over 10 years unless something fundamentally happens in the market where it doesn't make sense to sell. But that's kind of what I tell all of my investors. Look, here's the plan, 5 to 7 years. But if X, Y, and Z happen, we may keep it for 15 or 20 years. But likely it'll sell in the first 5 to 7. So that's the strategy, and that's just you got to look out for your investors, and that's the best use of their money. Truly, is if you do when you're doing a value add, right? When you're doing a value add, their best use of money is if you can recycle their money and then 1031 it into the next deal, into the next positive opportunity. And so it's less of what's best for you and more of a what's best for everybody, for what's best for them. And the cool thing I like about syndication, it helps you run it, I think, more as a business too. Not that I didn't run my real estate like a business. It just forces me to even be more efficient. I want to look professional. I want to make sure all my ducks are in a row. I want to make sure I've got a really strong, thought out business plan. I want to make sure this property is being running really efficiently, because it's not only me that I have to answer to, which it's really easy to lie to yourself. Right. For me, it's really hard to lie to other people. And so I have to look out for them, and I have to make myself look professional. And if I don't look professional, I'm only going to be doing 1 or 2 syndications. If I look really professional, I'm going to continue this for as long as I want. Right.
That's an excellent point. Now you're working for others essentially, and I can see that mind shift right there, as opposed to, like you mentioned with your own rentals. If somebody's a little slow on rent, it's like, I don't want to bother them, and then I got to turn it, blah, 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 that kind of thing. So that's great. Hey, we're running here a little long. I want to be sensitive to or respectful of your time here. Before we kind of wrap this up here, what's the one thing you would recommend our listeners do to develop their real estate portfolio?
Oh boy, that's a hard question to answer, because I don't know who I'm talking to. I'm talking to a lot of people, right? And so everybody's got a different opinion. But if you want to truly grow your rental portfolio, I guess first of all, figure out what your goal is, right? Figure out where you want to be. If that's 1,000 units, that looks a lot different than 10 units. So figure out where you want to be and where you want to go. And then from there, you just need to start working backwards. How does that look? What do I need to do? Do I need to bring in partners, or can I do it on my own? Am I happy if it takes me 10 years, or, do I need it to take 3? So I don't know how to that's a hard question to answer, but I would just say the most important thing is to figure out what your goals are, and then make those goals. And then again, be okay with shifting those goals, and be okay with growing your goals. But understand your goals and then focus on that. And I think that's maybe one of the things I touched on, is that it's easy to get distracted and see the shiny object. And that's what happened to me with flipping. But you make sure that you're focusing on what truly is going to make you happy, and what's truly going to, why did you really get into this in the first place, and make sure you're focusing on that.
No, I think that's very well put. Focus. I like it. Or I guess know what you want and focus.
Know what you want. Yeah. And then focus, be making goals and then be strategic about them. I think a lot of people just make goals and they're not strategic about it. They don't really think about it. It's easy to make a goal. I mean, anybody can make a goal. I want to make $1 million. Okay, cool. How do you get there? Let's figure out how to get there.
Right. This has been great. Before we say goodbye here, I just want to ask, what's the best way for our listeners to find out more about you or to get in touch?
Yeah, so I'll give you several resources. Always look me up on LinkedIn. I'm on there quite a bit, so they can look me up on LinkedIn. They can go directly to my webpage, which hopefully by the time this is aired, everything is up and running completely. We're working on it right now. So it's my webpage is Venture D, like my last name, Dexheimer. So VentureDProperties.com. And then they can also send me an email, which is todd@VentureDProperties.com. And then for sure, I'd love for any of your listeners to check out my podcast, of course, after they listen to yours. check out my podcast, which is Pillars of Wealth Creation. It's on iTunes and Stitcher and SoundCloud and all that kind of stuff, so they can find that. And I'm sure, like you say, give us some ratings and reviews. That's what we love, right? It helps us build our brand and get the word out there.
Well, that's right, and I would encourage all the listeners to check out your podcast. Like I said, I've listened to. I think I listened to the first one, but I'm excited to listen to more. And everything I've heard you present, Todd, you're a very clear thinker, and I think it's worth anybody's while to check you out and learn some more.
Well, it's fun. It's fun doing it, and Darren, I'm sure you're the same. You learn stuff from the people you interview. It's an enjoyable experience being on them, and it's an enjoyable experience talking to different people. And then it's fun to know that you're hopefully providing good content for the listeners, and just valuable information. There's so many people out there, different people that are listening to these podcasts, and it's just fun to be able to teach them something. And what a cool era that we're in, that we can learn so much for free. And we have never had a time like this where we can learn so much for free. It doesn't cost you anything to go onto a podcast and listen to it, and you can get so much from it. So I think it's cool. It's fun. It's fun.
Yeah, no, and to that, even just the opportunity then to connect with the listeners one-on-one. I've had multiple listeners reach out and have a conversation about whether investments or insurance or what have you. So it's all good. Well, hey, Todd, I've enjoyed this a ton, and really appreciate you doing this, and I look forward to doing it again soon.
Yeah, thanks for having me. Appreciate it.
All right. And for our listeners, if you like the show, share the show with someone you know. It's really easy to do. You can share our interview with Todd and his story and how he's developed his real estate investment portfolio. The more you know, the more you can develop and accelerate your own real estate investment portfolio. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.